Absolutely, we do. I think one of the points we've been making is for a couple of weeks now is that our preference for the U.S. is structural. I think we've clearly went through quite a dip in the early part of the year, and our preference is more so looking out over the next 6 to 12 months. But recoveries, especially off-market bottoms, rarely tend to be in a straight line. This morning, in fact, we were just comparing the path of VIX, so U.S. equity market volatility, with what it looked like in the months after March 2009. And these sort of rebounds have occurred in the past, so it's not inconsistent with history. And short term, we have been pointing to a couple of metrics that could have caused a pullback. So equity market positioning, of course, was quite long, almost set up for a bit of a breather. And other risk assets outside of equities, like the Aussie dollar, were looking quite stretched. So we were expecting a pullback, maybe not as quick or as deep as the one we got yesterday. But for us, our eye, looking out 6 to 12 months, still very firmly on whether measures like, whether expectations on the earnings side start beginning to bottom out, whether we get, data that's at least a little bit better or less bad than what's priced in, and that bond yields stay low. So I think as long as that economic recovery stays, on a path of recovery, we still sort of think equities are a good place to be at this time, particularly the U.S., which has a history of outperforming in sort of the late stages and now what we think are early stages of a recovery.